For this session, we will talk about your receipt or income and deposit system. So, as you all know, under the government accounting process, we have four systems generally. And those four systems are first, your appropriation, allotment, and obligation. Second system is your disbursement. Third system is your receipt income and your deposit. And the fourth system is your financial reporting system. So we're done with the two systems. We are now into your receipt income and deposit system. So what will you expect in this particular topic? What you will expect here is, of course, the recognition of revenue, which now gives us a receipt. And ultimately, this receipt must be deposited. When we say deposited, as a rule, general rule, whenever a collecting officer collects money, whatever is the collection must be deposited on the next day as an internal control system. And generally, that is deposited to an authorized government depository bank. But as a whole, the process of your receipt, income, and deposit system is first the recognition of revenue. How do we recognize revenue? So we need to determine if ever there is a difference as to the recognition of revenue under your government accounting manual as prescribed by your PPSAS and your financial reporting under your PFRSS. Next, the recording of that receipt of revenue. The receipt must be recorded by the collecting officer. And then lastly, the depositing of that receipt by the collecting officer to the authorized government depository bank. So those are the items that you will expect in this particular topic. So let's start. We start our discussion by defining what is your receipt income deposit system. So your receipt income deposit system is the system which covers the process of acknowledging and reporting income and collections and the deposits of collections with your authorized government depository bank or through the AGDB for the account of the Treasurer of the Philippines and recording of collections and deposits in the bank in the books of accounts of the agency. So generally, of course, you again record this one in a registry. And aside from your registry, you record it, of course, in your books. So the registry that is used here is the RROR. If you still remember that, that is your registry of revenue. Registry of revenue and other receipts. So this is the registry that is used here. But ultimately, in your receipt or income deposit system, we first acknowledge and report the income, so the revenue. We will learn how to account for that. And then ultimately, we receive it. That is known as your collection. And then lastly, we deposit it. Okay. Now, let's look into the fundamental principles of revenue. So under the government accounting manual, these are scattered items which governs or is used in recording or recognizing your revenue. So the first one, unless otherwise specifically provided by law, all income accruing to departments, offices, and agencies by virtue of the provision of existing laws, orders, and regulations shall be deposited in the National Treasury or in the duly authorized depository bank of the government. So what happens here is that all income, meaning all receipts, is deposited in the National Treasury. So in short, it will not be used by the government agency. Actually, maybe you will think, sir, what will happen therefore with the income? We thought before that whenever there is a fund, that fund comes either from the taxes or an internally generated fund, such as the revenue of the entity. We thought of that before, right? However, as a rule, before you can make use of that internally generated revenue, it must first be deposited in the National Treasury. And that revenue must also be appropriated to the entity. Take note, without an appropriation, you cannot make use of that money. That's our rule. Therefore, if you want to make use of the revenue or the entity's own revenue, then you cannot just make use of it pending any appropriation. Okay? So there must be a provision by the law on the appropriation of that revenue. So as a rule, all income must first be deposited. It must be deposited. In short, if the entity will have an income, do not just make use of that income. That's misuse of funds. You should deposit it to the national treasury. Next, number two, except as may otherwise be specifically provided by law or competent authority, all monies and property officially received by public officer in any capacity or upon any occasion must be accounted for a government funds and government property. Okay, so this tells that all receipts must be properly accounted for. Why? Because if you are entrusted with the responsibility over the public fund and you misuse it, you might be criminally liable. You might be criminally liable. So take note of that. Number three, amounts received in trust and from business type activities of government may be separately recorded and dispersed in accordance with the rules and regulations as may be determined by a permanent committee composed of the Secretary of Finance, Secretary of Budget and Management, and COA. Okay, so this talks about a permanent committee. Sir, what is that permanent committee? Actually, this is a special fund. This is more of a special fund. Um, as a rule, you must first place it on a general fund. As a rule, you must first place it on a general fund. However, you can also place it as a special fund and you can make use of it. And you can make use of it. So before, we call this one as with authority to use and without authority to use. So before, we call this one as with authority to use and without authority to use. When we say with authority to use, the agency is authorized to use the income for their operations. So before, we call it as with authority to use and without authority to use. Okay. So when we say with authority to use, this means that the agency is authorized to use the agency is authorized to use the revenue. But how do you use it? It is subject to, again, rules and regulations of a committee. And that committee is known as permanent committee. And if you are asked, who composes the permanent committee? It is the Secretary of Finance, Secretary of Budget and Management, and the COA. And a while back, what I discussed in number one is the without authority to use. So this is the general rule wherein all revenues must be remitted to the national treasury. Okay? All revenues remitted to national treasury. Sir, can we still call it with authority to use and without authority to use as of now? Actually, we can. We can do so because it is the same concept. However, the GAM or the Government Accounting Manual did not make use of those terms. And it's just spread through the different parts of the GAM. Therefore, I can say, although they have the same thought and it does not pertain to the same term, but again, the concept is the same. So for you to properly understand it, it's easier to make use of those terms. So number one means without authority to use. meaning all revenues must be deposited to National Treasury. While number three is with authority to use, wherein there is a permanent committee. This will be in the form of special fund wherein the agency can make use the revenue collected. Number four, unless otherwise specifically provided by law, all income accruing to the departments, offices, and agencies by virtue of the provision of existing laws, orders, and regulations shall be deposited in the National Treasury or in the duly authorized depository bank of the government. Okay, this is just the same with number one. Number five, except as may otherwise specifically provided by law or competent authority, all monies and property. This is just the same again. I think number seven is the new one here. An officer charged with the collection of revenue or the receiving of monies payable to the government shall accept payment for taxes, dues, or other indebtedness to the government in the form of checks issued in payment of government obligations upon proper endorsement and identification of payee or endorsee. As a general rule, you know that all collections must be paid through cash. However, we can also accept checks. But the question here is, what happens with the check? Should we accept first the check? Okay. You can accept the check upon proper endorsement and identification of payee or the endorsee. So it must be properly endorsed to the government entity. And then after the proper endorsement, that check must be deposited to the National Treasury also through the AGDB. However, the problem with your checks is that what if it is dishonored? So how do we account for it? So later we will discuss also how to account for a dishonored check. And then lastly, number eight, under rules and regulations as the GOA and DOF may prescribe, the Treasurer of the Philippines and all AGDB shall acknowledge receipt of all funds received by them, the acknowledgement bearing the date of actual remittance or deposit, and indicating whom and what account it was received. So before, when I was working in the government, what we normally do is we compare the receipts, and based on the report of the collecting officer, we compare that, the receipts and the report of the collecting officer. Then after we compare that receipt and the report of the collecting officer, we total that amount and we look into the deposit of that particular collection. So as a rule, as I told you, if ever it is collected today, it should be deposited tomorrow. But if you still have time today, then you can also deposit it today. So some government entities make a cut-off. So all transactions or collections up to 3 p.m. should be deposited within the day. And next day, the other transactions, etc. So that's how they do it. So we in the COA before, what we do is we compare these collections, we compare the report, and we compare also the deposit. Primarily to look whether this particular system is in place and in check, and all controls are properly in place also. So that's how this system works in a particular government agency. Now let's talk about your accrual of revenue. So how do we accrue your revenue, or where do we place your revenue? So we place your revenue to the general fund. That's the general rule. So unless otherwise specified by law or regulation, all revenue accruing to the department offices will be placed to the general fund. The general fund is placed in the National Treasury. Do you still remember this? This is the item number one we discussed a while back. And then it can also be accrued to a special fund. So receipts shall be recorded as revenue to your special fiduciary or trust funds or funds other than your general fund only when authorized by law following the rules issued by the permanent committee. And you already know that permanent committee. So that permanent committee now you have the authority to use. You have the authority to use the fund. Okay, it is uh, it is with authority to use whatever is collected. However, sir, are there instances wherein the amount of a special fund or with authority to use will be transferred to the general fund? You know that the general fund is the national treasury, and this is without authority to use. Right? So, are there chances that this special fund is reverted to general fund? Okay, there are chances wherein it is reverted to the general fund. First, if ever the purpose are not already met or is not met, purposes are not met. So if ever the fund is no longer necessary for the term attainment of the purpose, then you now revert it to the general fund. Now, another reason wherein we revert your special fund to general fund is if ever it is needed by the general fund, particularly in the times of emergencies. So let's say there is a pandemic, so we can revert some items of your special fund, which is with authority to use, to your general fund. Again, when we talk about these items, general fund and special fund, we're not really talking about the fund itself. We're talking about the revenue and where we will place it, whether we can make use of it or not. I hope that's clear to you. So when I talk about general fund, that is the amount of revenues or receipts of the entity which is without authority to use. Therefore, it must be remitted to your national treasury. However, if that is a special fund, it is the revenues of the entity which is with authority to use, subject to the permanent committee. And when we say authority to use, that authority to use is for a specific purpose. Now, our problem is, are there chances wherein the special fund will be reverted to the general fund? Yes, there is. The first one is the change of purpose or non-attainment of a purpose. Next is that there is a need for a general fund due to emergency. And another is a violation of the rules promulgated by the permanent committee. Okay, promulgated by the permanent committee. So if ever there are rules and the rules or conditions set by the permanent committee is not met, that should be reverted to the general fund. Sir, how about a general fund to a special fund? Can we revert it? Can we revert a general fund to special fund? No, you cannot revert it, because as I told you, the general fund can only be used through an appropriation. So there must be an appropriation already for you to make use that general fund from the national treasury. Okay. So what is revenue? So revenue is defined as fund comprises of income of any agency of the government and available for appropriation or expenditure in accordance with law. So when we talk about appropriation or expenditure, when we say appropriation, that is the general fund, right? Because you can only make use of it upon appropriation to you. While expenditure are of your with authority to use or your special fund. Now, upon knowing the concept of your revenue, let's look into the different sources of your revenues and other receipts. So your sources of revenue is through exchange and non-exchange. Actually, this is quite the same with your financial accounting, wherein revenue is recorded through exchange or non-exchange. And under your financial accounting, it is accounted using your PFRS 15, if you still remember. That is your revenue from contracts with customers. However, this revenue for your government accounting is governed by your GAM together with your PPSAS. Okay? GAM together with PPSAS. So first, let's define what is an exchange. So when I say exchange, just like in your financial accounting, this is where one entity receives asset or services or has liabilities that had been extinguished, and you give goods or services. So there is a reciprocal transfer. You already know that whenever we talk about exchanges, there are reciprocal transfer. Now, when we talk about non-exchange, here there is no transfer. So what happens here is uh, there is only a transaction which one entity only receives, the other does not give. While in your exchange, one receives, one gives. In non-exchange, only one receives. Only one receives. So the person who give receives. There's a person who gives, there's a person who receives. In in exchange, the person receives and gives, and the other person also receives and gives. While in non-exchange, only one, only one. I hope we're clear with that. I hope that whatever you learned in your financial accounting is still the same concept here in your GAM and PPSS. Now, when we talk about your exchange, your GAM enumerated two items of exchange. So the first exchange is the sale of goods or provisions of services to third parties or to other NGAs or non-government agencies. So when we say sale of goods or provisions of services, there are two items of exchange here. The first one is the sale of goods. The other is the provision of services. So those are the two, sale of goods and provision of services. So when we talk about sale of goods, if you remember under past two, when can we say that the inventory or the goods, diba? Under past two before in your financial accounting, when can we say that the goods are already transferred? Or under PFRS 15, when can we say that the goods are already transferred? When the risk and rewards of ownership of the goods are already transferred to another person. So the same concept is still governed under GAM. So when we talk about sale of goods, when do we recognize the revenue? We recognize it when there is a transfer of significant risk and rewards of ownership of the goods. Okay? And you have no continuing managerial investment. So the same rule. But one different item under the sale of goods here in your exchange in the recognition. So under financial accounting is still risk and rewards of ownership, no continuing managerial involvement. It is probable, it is measurable. So those are the items under your financial accounting. While in your GAM, these four items are still present with the addition of one. The addition of one is the cost incurred or to be incurred is measured reliably. So meaning the cost of your sale can be measured reliably. So this is quite new with this particular item of your government accounting. So the same rules, how do we measure is still fair value, still the same rules with your financial accounting. The difference only is the last item as to the measurement of your cost of your sale. Next, we have your provision of services. So under your provision of services, generally under your PFRS 15, we recognize it in time or over a period of time. So I hope you still remember that. So we recognize revenues in time or a period of time or over a certain period of time. So when we say at a point in time, so you recognize it now only over a period of time, over a certain series of period. Now, under your provision of services, how do we recognize it? So we recognize it under straight line basis generally, okay? Straight line basis. Whenever we talk about services, it does not talk about at a point in time or over a period of time. So under GAM and PPSAS, when we talk about provision of services, we recognize it this way: straight line method or percentage of completion only. So those two. So in short, it is like more of a recognition over time. Because when you say straight line method, that is a series of time again. Percentage of completion, it takes a lot of time or it takes a period of time before a services is completed. Therefore, under provision of services, generally, it is mostly over a period of time. So again, one difference under PFRS 15 versus GAM and PPSAS. Under PFRS 15, what we do is at a point in time or over a period of time, and we follow the five-step model of revenue recognition. However, here, we look the straight line or percentage of completion, whichever best reflects the transaction. Now, as to your recognition of your provision of services, so under financial accounting, if you still remember, we have your probable and measurable. Aside from probable and measurable, as to the completion of the transaction, that's how we measure it. But under GAM, aside from the three, probable, measurable, and the process of completion of the service, we still measure the cost of services. Okay? So this is another new item as a requisite of your recognition. So here, we now need to measure the cost of services. It must be measured reliably. Here, we can also need, or we are also need to we do need to measure the cost of the sale. So take note of those changes. Next, we have your use by other entity of assets yielding to interest, royalties, and dividends or similar distributions. So this talks about your revenue arising from the use of other entities of your properties of the entity or the government. So at the usage of that government asset or property, there is an interest or a royalty or a dividend. So this is again recognized as an exchange. Why is it an exchange, sir? You lend them your asset or a property and you receive in return interest, royalty, and dividend. That is for exchange. How about for non-exchange? For non-exchange, as I told you, this is wherein the transaction, the entity only receives value from the another entity without giving an equal value on that particular receipt. So your non-exchange comes from the following. First, tax revenue. So when we say tax revenue, generally these are your tax collections. But this should not be grossed up with tax expenditures. Sir, what is a tax expenditure? So when we say not grossed up by tax expenditure, a tax expenditure under your GAM is known as tax expenditure. So tax expenditure under your GAM is known as your preferential taxes. Or exemption. Okay. So, for example, you have collected from entity A tax of 300,000. Entity B should be taxed at 200,000. However, entity B is exempt. Okay. So, how much should you present as a tax revenue? You present it not gross up of the tax expenditure. So, meaning only at 300,000. So although you should have an income of 200,000 here, you should not add it to the value of your collection. Okay? You should not gross it up with the tax expenditures. So if ever there are tax expenditures such as exemptions, preferential taxation, please do not add it to the amount of what is only collected. So in short, a tax expenditure is a foregone revenue. Do not record it. Okay? Do not gross it up. I hope we are clear there. Again, as an example, entity A has 300,000 tax due. Entity B has 200,000 tax due if ever it is taxable. However, entity B is exempt. How much should be recorded? We only record 300,000 pesos. Why? Because the tax expenditures such as preferential taxes or exemptions are not recorded, or are not grossed up with your tax revenue. So therefore, tax expenditures are foregone revenue. Next, we have your fines and penalties. So fines are economic benefits or services which is received by the public sector or the government from any entity after a particular determination based on the law. So, for example, you violated an ordinance, so you must pay a particular fine. So, they are recognized also as non-exchange. Why non-exchange? Because you did not do or you did not give anything, however, you received something. Okay? You received the fine or penalty. How do we measure it? We measure it at the fair value of the fine or penalty or the amount to be received based on that fine or penalty. Furthermore, you measure it or recognize it once it becomes probable and measurable. Next, we have your shares, grants, and donations. So when we say grants or donations, generally these are any grants or donation in favor of the Philippine government. So one thing that you need to take a look in your grants and donations is whether the grant or donation is with condition or without condition. If it is without condition, then you should already recognize it as a revenue. But if ever it is with condition, how do we account for it? When it is with condition, instead of a revenue, you account for it as a liability. As a liability. Generally, it is a deferred income. If you still remember the concept of your government grant under your financial accounting, wherein the grant with a particular condition must be recorded as a deferred income. It's still the same concept here whenever there is a grant or donation with condition. You account for it as a liability or as a deferred income. So for example, you receive 500,000 pesos as a donation from entity A to put up a library. Okay, so the condition there is to put up a library. So the time you receive the 500,000 pesos grant or donation, you measure it as a liability. So you debit cash, collecting officer, and then you credit your deferred income. Okay? That's how we measure it. We account for it as a liability. And when can we recognize it as a revenue? When do we recognize it as a revenue? Once you meet the condition. Okay? So once you meet the condition, then you can now recognize that as a revenue. Now, impairment of receivables. So some revenues are not received outright. So some revenues are not received outright. So that can be considered as on account. So a revenue, as you all know, can either be on account or on a cash basis. So what happens if ever this account is considered impaired? Okay? Once it is impaired, you still account for an impairment loss. You still account for an impairment loss. Actually, this is the difference under your financial accounting and your GAM. So under financial accounting, you learn that you measure it using your ECL. Okay? It must be measured under your ECL. While under your GAM, it is not through ECL. When you say ECL, you expect at the time you have a receivable that some items of that will not be collected. So expected credit loss. That the amount of the account is already expected at the time of the account that there is an impairment to it. While under your GAM, it is your incurred loss. Sir, what's the difference with expected credit loss and your incurred loss? Under your expected credit loss, what happens here? Again, as I told you, let's say January 15, you have a receivable, 1 million. So the time of January 15, you already project a possible impairment. If you still remember, there are certain levels here, level 1, level 2, level 3. Okay, so at the time, that is your level 1. It is not quite sure the amount. Okay, that's how your ECL works. At the time, you already recognize. You expect a loss. However, under your GAM, it is only incurred. Why do we say incurred? You only recognize it whenever there is really uncertainty as to the collection or to the uncollectible amount. Okay? When we say incurred loss, you only record when it happens. Here, you project. Here, when it happens. And GAM uses this. Before, in your financial accounting, when we still use past 39, we use your incurred loss. However, when PFRS 9 was presented, what we make use already is your ECL. Therefore, because of this change, now there is a difference between the accounting of your receivables under financial accounting and your GAM. Because guys, as a general rule, items of your PPSAS and your financial accounting are the same. So recognition of borrowing costs, recognition of your inventory, etc., etc. You have the same concepts. What we're looking into here are what are the differences as to your government accounting and your financial accounting. So as you can see, as we go through different topics, we emphasize those differences. Main difference, of course, is the accounting of registries. Also, the accounting of appropriation, allotment, and obligation, including the meticulous recording of the disbursement. However, as to your revenue and your financial reporting per se, they are actually the same, except to certain instances, wherein if this instance will pop up, I will always compare it to your financial accounting. So here in your impairment, what we use here under your GAM is your incurred loss, while in your financial accounting is expected credit loss. Now, if you still remember how to compute for your impairment of receivables, if you still remember, so there are different methods, right, on computing particular bad debts. Normally under GAM, what we use is a schedule. So aging of receivables, that's what is used under GAM. Now, let's look into your receipt and collection process. So we're done talking about your revenue. We're talking about what if it is impaired. Now, after you receive that revenue or after recording that revenue, then you can now receive. Okay? So how do we, or what's the process of your receipt and collection under the government? So the first one is that the collecting officer receives payment from creditors and issues official receipt. Take note, official receipt is only given by the collecting officer upon receipt. That's why I told you a while back, whenever we audit items of your receipt and collection process, what we compare is the receipt and the amount of the report of the collecting officer together with the deposit. That's how we do it. Because we know that under the government, once the collecting officer receives something, that's the only time the collecting officer will issue a receipt. The difference here in your financial accounting is that once there is a revenue, you can issue a receipt. But in government, you will only issue a receipt upon collection. Okay? So upon receiving of payment, you issue the receipt. Next, the collecting officer records collections in the cash receipt record. And then the collecting officer deposits the collection. And then the collecting officer records the deposit in the cash receipt record. So this is the report that is given to us, which we compare with the ORs together with the deposit slip. Number 5, the collecting officer prepares a report of collections and deposits and forward to accounting unit with copies of original receipts and validated deposit slips. Actually, aside from that, the collecting officer will also forward that to the COA for auditing. And lastly, the accounting unit prepares a journal entry voucher and records it in the cash receipts journal. Just remember the gist of this process. There's a revenue, you record that revenue upon receipt. That receipt must be deposited. That is the whole process. Now, as to your entries, so your entry as to your receipt, you debit a cash collecting officer and you credit other accounts. So let's say you collected an accounts receivable, then you debit cash, CO, and you credit accounts receivable. Okay, that's how we will record it. Now, how about remittance? In your remittance, you debit cash, treasury or agency deposit, and you credit cash collecting officer. Sir, why do we debit cash, treasury, or agency deposit? Because as a rule, your money must be deposited in a general fund. As a rule, your money must be deposited in a general fund. And your general fund is your national treasury. That's why you debit it to your cash national treasury. Now, what if there is an overage or shortage? How do we account for it? First, on your overage, this is discovered by the auditor and cannot be satisfactorily explained by the collecting officer or disbursing officer. It shall be forfeited in the favor of the government, and an OR shall be issued by the collecting officer or the cashier. So take note, it must be forfeited in favor of the government. So how do we account for it once it is forfeited? It is treated as a miscellaneous income. It is treated as a miscellaneous income. So when you record it, you debit the overage to cash collecting officer, and then you credit it to miscellaneous income. So let's say, for example, your total collections is 8,000. And then, per your receipts or your OR, it is only 7,000. Therefore, there is an overage of 1,000. Okay? So how do we record the overage? So you record the overage by debiting cash collecting officer and crediting miscellaneous income. Now, once that amount is also remitted, so upon remittance or deposit, you debit cash, treasury, and then you credit cash collecting officer. That's how we account for the overage. Take note, it is forfeited in favor of the government, and it must be credited as miscellaneous income. So the difference here, in your financial accounting, what we do if there is an overage is to determine the reason why there is an overage. And in determination of the reason, if ever it is in favor of the collecting or whoever is the cashier, you give it to the cashier. But if not, if it is not for the cashier, then it is treated as miscellaneous income. That's the rule under financial accounting. However, in government accounting, as a rule, walang mapupunta kay collecting officer. Agad-agad yan kay government. So you don't look at it already. You don't determine if ever this money should be given first or is it attributable to the cashier or not. You don't look at it that way. And under government accounting, the whole overage must be placed as miscellaneous income attributable to the government. Okay? That's for overage. How about shortage? For shortage, it is not restituted to the collecting officer or disbursing officer despite demand in writing by the auditor. It shall be taken up as a receivable. Okay? It shall be taken up as a receivable. So directly, it is a receivable. Unlike before in your financial accounting, what you do is it attributable to the collecting officer? If it is attributable to the collecting officer, then what we do is we set up a receivable. However, if not, then we treat it as a loss. Here, there is no restitution, meaning you cannot recognize a loss. So no recognition of loss here, directly a receivable. In your overage, no recognition, directly it is treated as a gain, a miscellaneous income, no recognition of a payable to collecting officer. Okay? Here, no recognition of loss, directly it is treated as a receivable. So how do we account for it? So to account for the receivable, we debit your other receivables, and then we credit your cash treasury. Sometimes it is your it's not cash treasury, it must be cash collecting officer because it is not yet remitted. So other receivables, cash collecting officer. Actually, you can also make use of your due from collecting officer. Okay, you can also make use of the due from collecting officer. Once you collect it, upon collection, you debit cash collecting officer, you credit due from, and then ultimately you now remit it, you debit cash treasury, and then credit cash collecting officer. Okay, that's how we account for shortage. Again, for overage, you account for it as a gain, no payable to collecting officer. In shortage, you account for it as a receivable, no recording of loss. How about in a dishonored check? In a dishonored check, what happens here is you receive a check, however, it is drawn against insufficient fund or not enough fund or NSF check. So what do we do here is to first record the cancellation of check. And how do we cancel the check? The problem here is that you receive the check, right? You receive the check. And upon receiving of the check, you deposit the check, right? It is already deposited. Therefore, in the cancellation of the check, what you need to do is to cancel also the deposit. So you need to credit cash treasury. And then you need to debit now your receivable. Sir, why do we credit cash treasury here? Because the check is already deposited. And since it is deposited, you need to remove an amount on your deposit on your cash treasury. And now you set up the receivable. Now, after that, once the check is redeemed or replaced, so check is replaced, we record it as a debit to cash collecting officer and we credit the receivable. And then lastly, again, the check is now deposited. You debit cash treasury and then you credit cash collecting officer. Just take note, every time there is a deposit, you record it this way. You debit it to cash treasury and then you credit it to cash collecting officer. And once you collect something, you always debit it to cash collecting officer. Okay? So if ever there are questions that will come out in this particular system in your board exam, generally it is just the recording. The same recording of recognition of revenue. So if it is a cash sale, you debit cash, collecting officer, and then you credit sales. That's how you record it. But how do you deposit it? When you deposit your collection, it is treated generally as placed as without authority to use, so general fund. So you debit cash treasury, you credit cash collecting officer. Take note, all items received is debited to cash collecting officer. Sir, why? Because it is presented as a way that that particular money is held by the collecting officer. So that's it. The end of your income or receipt and deposit system. So let's just wrap up this particular topic. So in this particular system, we talk about your revenue. And your revenue can come from either exchange or non-exchange. It can come from either exchange or non-exchange. Now, the same rules cover whenever we record now the receipt. So the receipt of revenue. To record the receipt of revenue, we debit cash collecting officer. We credit the different accounts, either the revenue itself or a collection of receivable. And then this revenue will be deposited already. Whenever we deposit it again, we debit cash treasury and we credit cash collection officer or collecting officer. And then this collection can either be or can result to overage or shortage. If overage, it is treated as a gain. So what we do is we debit cash collecting officer and then we credit miscellaneous income. When it is shortage, we treat it as a receivable. So we debit due from collecting officer and we credit cash collecting officer. Now, the deposit, what if the deposit is a dishonored check? So first, we record the dishonor. To record the dishonor, we debit your other receivables to set up the receivable, and then we credit cash treasury. And once the check is already replaced, we debit cash collecting officer, and then we credit your other receivables. And then lastly, that is now deposited. And we said in your deposit, there are two instances that can be to the National Treasury or to your special fund. Okay? That is through your National Treasury or through your special fund. So if that is through your special fund, it must be through your permanent committee. But as a rule, it is always National Treasury. That's why we debit cash treasury. Cash treasury. Sir, what if it is special fund? If it's special fund, you don't need to deposit it. It will be under your cash collecting officer only. Okay? It is only held by your cash collecting officer. Or if you want, you can deposit it and you deposit it as agency. So you debit cash, agency deposit. So by the time it is not held by the collecting officer but deposited under the name of the agency, not as the name of the treasurer. Again, you debit. If ever it is a special fund, you debit it to cash agency. Okay? You debit it to cash agency. In debiting it to cash agency, it means that the agency can make use of that fund. So that's it for your income, receipt, and your deposit system.